Okay, I've got some time early in the morning, and so I'm going to go over some of the commodities and just discuss what I see. The key thing I wanted to discuss was some of the commodities. Now, the first thing, of course, is gold. Now, gold has recently had a nice rally, and of course, that was extended from the previous rally. But I want to show you here this chart. Now, you can see that gold showed some weakness here, but bounced off this short-term support, is going higher. Now it is encountering some resistance now, as you can see, at about 134, and that resistance will last through 135, even 136 to fill that gap. And this is another chart, 6-month chart. So you can see that gold has extended a little beyond this trend line here. This is the basic trend line. Okay. The bearish trend line. Now remember that I have been discussing that gold is going to trade in a seesaw pattern, right? But it's going to be making lower highs and lower lows in general. And that is exactly what it has done. Now, that doesn't mean that it can't violate this general trend. And it's doing it now probably because of the situation in Egypt. It gives an excuse for gold traders to, push the price up. But we are beginning to run across some resistance here at around 135. Now, it could break through that 135. There's no doubt about it. Next resistance would be in the 142 range, and it could even break through that and fill this gap at 150, 155. Now, you'll note that I believe in the July issue of the Intelligent Investor, I did mention that, I think that gold was going to rally to the 150 range pretty soon. So, this might be it. But keep in mind that when you're trying to trade something that's in a bearish trend, you have to be very careful about that. So you want to be more biased towards the downside, towards the short side of the trade when you're dealing with a bearish trend, right? Even if you miss some of that upside, because it's better to miss some of that upside and focus on the downside, whether that means that you are short longer or whether you stay out of the long side, or you cut your gains in the long side before you are able to extract all that upside. You want to make sure that you're biased towards that bearish trend, okay? Even though we might be experiencing a short-term bullish trend, which is what we are doing, or even a intermediate term trend, which is not the case at this point. Keep in mind, you want to understand where you are in the trends. You want to know the long-term trend, the intermediate-term trend, and the short-term trend. Right now, we are in a long-term and intermediate-term bearish trend. The short-term trend in gold is bullish, okay? So these are basic things to note as you are making these trades. So I'm just going to remove these markings now so that you can see the chart, the bear chart again. And this is a 1-year chart of the GLD. And it's a similar situation. You can see the bearish trend line. And this is a long-term. It's kind of long-term / intermediate term. But similar situation. The resistance line is a little different when you look at the chart of this duration, but it's similar. And of course, these resistance and support lines are not just, they often span more than just one point, right? So, you could argue that it's also up to here, right? But that doesn't matter. What matters is to basically understand where these things are, support and resistance. And so we are seeing gold test this resistance right now. And again, it could bust through and hit the 140. I don't know what it's going to do. I would say there's probably a slightly better than 50% chance that it's going to at this point. But what's important now is to monitor how the market responds to these events going on, situation in Egypt and other events as well. Now keep in mind, in addition to some of these other events, that the stock market, the U.S. stock market, is weak, is showing weakness. It's been showing weakness now for a couple of weeks, and that typically is a somewhat bullish sign for gold. However, also keep in mind that gold has previously lost that characteristic of serving as a hedge of a declining market. Doesn't mean that it won't regain that characteristic. I tend to think that right now during this period that a weakened stock market is probably going to help gold a little bit. Probably not as much as in the past, not recent past, but in the say in 2012 and 2011 and 10. So I think that is a positive. And then we have a 2-year chart, and it's a similar situation once again. Draw the resistance here at about 131, and then you get the longer term resistance here at 150. So I don't think, it's going to take a pretty powerful series of events to push gold substantially above this 150. It could happen, but during this particular rally, this cycle, I doubt it. I seriously doubt it. But we have a smaller resistance here. And so at this point, it's a pretty good chance that gold is going to test this 140 resistance. I'm not saying it's going to. It's a good chance, though. I think there's a much better chance it's going to hit around here, right? Around this mark right here. But if gold hits, 140-ish, I would definitely be selling it. And it might even, depending upon what type of trader you are, what kind of profits you've made in trading gold, I would look for a sign, a trigger catalyst to even short it. And that catalyst would be, some type of an important downward move. And also, you might want to consider what's going on with the dollar and with the U.S. stock market as a part of that catalyst, right? If you see the stock market start to gain some strength, and you've got that gold at 140, and it looks like it's hesitating or even weakening, then I think that would be a pretty good catalyst to put a short position in, definitely a sell position. So here we have the actual gold chart. We're looking at the gold ETF, and of course, when you're looking at shorter term periods, the GLD is pretty similar, but as you expand that period because of the cumulative effects of the cost and how this thing tracks gold, you're going to lose some of the pricing. But it's basically the same. You can see here, you've got this 135 or 1350 resistance. It's a little bit different. Pretty much the same. I think in general, after the big decline that we've seen in gold, this period here when we had this very big sell-off, I think it was a signal, it was a buy signal, because it was accentuated. It was much more than what this trend was showing, right? And just because gold is selling off, assets don't sell off completely all the way down in one move or two moves. It's usually stepwise process. So experienced traders knew this is a pretty good time to buy gold, especially once you got this small rally right here. Even though it sold off, even though the best traders probably would have waited for this right here to get in after it sold off. That's typically, it's not always, you can't predict these things. It's just kind of a better than 50% probability. So that's something to keep in mind for in the future to see it again. But of course, also keep in mind that all these things must be adjusted to the current events that are going on, current news and so forth. Okay, so you can see this is SLV, and it has recently soared from the high teens to 2250. 1 month chart. It's a 5-day chart. It's a 3-month chart. So we can see now it too is testing its resistance. So let's have a look. And it's probably a little further along testing its resistance than gold is. And remember, once again, when these things move, when gold and silver move, silver typically moves by a greater extent. Silver is going to have more volatility. When silver and gold go high, silver typically goes higher. When gold and silver go low, silver typically goes lower. So it's a better trading security or asset typically. Okay, we've got a 6-month chart here, and this gives us a better vision of what's going on. And so you can see that, of course, silver has not broken through the resistance yet. You know, it kind of barely has, but that's not really hasn't really been confirmed. Hasn't held up long enough and hasn't gone high enough. But it's such a strong move that we have to kind of overweigh this move a little bit. And we do have a minor resistance here at just under 24, let's say 23.5 or so. It's not that much. And then we have another minor one here at 26. The major resistance comes in, of course, at 28. Now, I don't think we're going to get to 28 in this move. I don't have a crystal ball, of course, but you know, I think that 24 is very possible. And we might even hit, approach 26. But once again, keep in mind, we are in a bearish trend in silver. Long term, intermediate term, bearish, short term, bullish. So at the end of the day, you don't want to get too excited with silver. You want to keep these things in perspective. Now, in the past, when I did call the end of the gold and silver bull market, I did mention that 95% certainty. So there is a possibility, a small one, that we could see the reemergence of these bull markets down the road. I just don't think it's going to happen, but there is that 5% chance. It would take a lot. Once again, we have the resistance here at 22. I'll show the support here at 18. And then we have the major resistance at 28. And then you can see, it's kind of a tough road up through 34. So if you're trading this, then there's several ways to look at this trend. You can look at it this way. This kind of gives you an idea of the trading range, the bearish trading range volatility. And if this is, roughly accurate, then it means that, we're probably going to get to around the 24 on this. Of course, it could overshoot, it could undershoot. This is just very rough, very approximate. There's no golden rules to trading these things in technical analysis. These are just tools that help us a little bit. Now, some of you want to go and look at a lot of other things, technical indicators, fancier things, that's fine. I don't use this stuff that much. I very rarely look at this stuff. I haven't looked at a technical indicator probably in several months. So these are the Bollinger Bands. I just, it might help you when you are more of an amateur. I know a lot of experienced people who love Bollinger Bands and who love all these technical indicators. I'm just telling you what my approach is to keep things simple and to use the basics. In my opinion, if you understand the basics, then you are not clouded. Because every single one of these technical indicators, and there are hundreds, they're all based upon support, resistance, volume, relative strength, those basic fundamentals. So if you can read a chart and look at support, resistance, adjust it with the volume, understand the relative strength, some other things as well, kind of a relative momentum, then you don't need any of these technical indicators at all. But until you can do that, you might want to look at some of them. The MACD is a good one. You know, the RSI is a good one. You could go through and read, you know, how to use these things. I'll tell you, and of course the moving averages are good. I also like Williams percent R. But, you know, typically, you know, these things are much better, in my opinion, for short-term trading. You know, it's doubtful that you'll ever find anyone who uses technicals a lot like I do, who doesn't use these indicators. I don't know of anyone else that doesn't use them. But, you know, I'm not a textbook guy. I'm a maverick. You know, I blaze my own path. I've developed a system that works for me, and I think a lot of people are followers. You know, they go by all these things in technical analysis because it's kind of the sheep effect. You know, they look at technical patterns. They memorize the patterns. I don't have these patterns memorized because I think it's kind of like using a calculator all the time. You know, you can use a calculator for simple calculations, and then when it comes time to do even a simple calculation, you're not able to do it because you're not exercising your mind. So, and also a lot of these chart patterns end up being a false epiphany. People rely on the patterns more than what the chart is telling them. They no longer read charts anymore. They begin to recognize patterns because they want shortcuts. They want the simple way out. And this is why a lot of people just don't really master technical analysis. You know, I think that once you've really, really mastered it, yeah, you can go and look at the chart patterns and point to that. But there's so many subtleties that unless you're really, really experienced and you're a true master of technical analysis, I think that using chart patterns is probably going to hurt you more than help you. And so we have the silver chart here. And now this gives us a little different picture. I'm drawing the resistance at 23 here. You could draw it at 22 as well. This is kind of the top layer of resistance at 23. This is the bottom border, the bottom layer of just the 22. So as I mentioned earlier, when I began talking about silver, I said that silver had made a better progression through its resistance than gold. And you can see that here. And then we've got the major resistance up here at 28 and some minor resistances here. And it's a 2-year chart, give you a better perspective of, you know, the move in silver. It's been a nice move, but it still hasn't changed the bigger picture, bearish picture for silver. The 26 and the 28 resistance. You know, that's what I would be looking at. I mean, the 24, it may even fail to 24, and you might see a sign there to sell or short. But definitely, if this thing gets in this cycle, in this trading cycle, this thing gets to 26, you want to really look for reasons to sell or short this thing. Okay. Now, be very careful. If you're not experienced shorting securities, please don't short. Okay. I only mentioned shorting here because when you're talking about commodities and forex, it's pretty common to short things in that type of market. But in general, shorting is a very risky maneuver. It's just not as risky in the commodities and forex, just because the long and the short, it's kind of a, you know, you're dealing with short-term contracts in that situation, and so often the long position is just as risky as a short, or almost as risky. It's different with stocks, but just, you know, you shouldn't short something just because you think it's going to go down. You always want to look for a trigger. You can sell something because you think it's going to go down. Shorting is a different story. Okay, so just very briefly, I wanted to look at dollar index, look at 10-year note, and then we're going to go to oil. So you can see that the dollar has sold off since early July. Of course, it's kind of a an up and down cycle, and as well during that time the oil has gone up, right? Which is what we would expect, that relationship, since oil is traded for dollars. And here we have the 10-year Treasury note, and you can see it has collapsed for the past few months, of course, as the yield has gone up, right? And so this kind of makes sense with the dollar. And this is the 10-year Treasury yield. And since hitting a recent low in May of about 1.65, it soared. And now it's above 2.8. And of course, I think that, I've mentioned a couple of months ago, it's probably going to hit a 3% mark, around the end of the year, maybe early part of next year. And what that means is that for those investors who are looking to build positions in bond funds, there's no rush. You want to go very gradually, okay? Because you should expect bond funds to continue to sell off. Over the past several months, bond investors have been fleeing bond funds. They've been selling. I believe since around May, about $120 billion sold in bond funds. Could be even more. This month so far, August, it's the fourth month on record for outflows. And we had the number one month, I believe it was May or June. So, and this is all based upon the increasing yield. Investors don't want to get stuck, right? But, the reality is that they're not in as bad of a position when they're in bond funds. These bonds are managed. The problem is that ultimately, when you're talking about bonds, all that really matters is what investors do. If for whatever reason they're selling their bonds, then the yield's going to go up, right? But they're selling their bonds because they think that interest rates are going to go up, which will drive yields up, you see. So it's kind of they're kind of creating a self-fulfilling prophecy on their own, and nothing can be done about that. Even though investors are probably doing the wrong thing based upon what I see, it doesn't matter because they're leading the charge. They're leading this thing. They have the power right now. I mentioned in a recent video, I think it was a Ron Paul video. And by the way, these videos that I do when I'm educating Ron Paul and Peter Schiff and Mark Faber and exposing these guys and making fun of them and showing you how clueless they are. Aside from the entertainment value, I hope that you are learning, because a lot of these videos are very educational. I'm going over forecasting, I'm going over what's going on in the economy, and I'm going over important points. So hopefully you are taking those videos pretty seriously from an educational standpoint. There's a lot, I believe, of educational value to be had from those videos. And one of the points I made in the Ron Paul video, which I think I released today, was that just because the Fed scales down on quantitative easing or even stops it, doesn't mean that they're going to raise interest rates. Those are two somewhat separate events. Yet investors are treating their speculation of when the Fed is going to taper quantitative easing as an increase in interest rates, which is completely wrong. Now, if the Fed is going by strength in the economy as a gauge by which to begin scaling down on quantitative easing, then they're not going to do it this year, or it would be November, December, because the economy is getting weaker. There's no doubt about that. If, in fact, their criteria is based upon the economic strength, it's just not going to happen. Now, of course, they could be lying. They could have ulterior motives and so forth. But I think it's pretty obvious, and I made this point before, The Fed has even since backtracked and said, hey, you know what? The economy is not going as strong as we thought. Nevertheless, the bond sell-off has begun, and it's going to be difficult to stop yields rising to 3% and above over the next several months. And that is going to continue to add pressure to the stock market. It's definitely going to continue to add pressure to the bond market. But once again, the key issue is with this exodus in bonds and bond funds, if you are trying to build a position in a bond fund, be patient, okay? And now in the dividend gems, we have 3 bond funds, and I've continued to put, add gradually. Be patient, okay? Be patient. There's no need to rush. You want to build your position gradually. I think that there's more downside to these things. One final point is that we're seeing continued weakness in the mortgage REITs, the paper REITs, and we cover, I guess there's maybe just one paper REIT that we cover. We've got about 3 or 4 REITs in the dividend gems. One of them is paper, I believe. The others are more real estate. But for those of you who are interested in the paper REITs, I think that there's going to be more downside because the yields are increasing. And as the yields increase, you're going to see a further decrease in the book value of the assets of these REITs. So I think that, you can be patient when building a position or adding to your position in the paper REITs as well. So that's why I wanted to bring up this point about the yields. I didn't want to spend this much time on it, but that's the way it goes. So now that we've talked about the dollar and the treasury price and the treasury yield, let's go and talk a little bit about oil. Okay, so from the recent commodities portion of the Intelligent Investor, or those of you who bought the commodities report, you'll note that in July, when the Brent was 108, we basically said you want to sell this thing soon, okay? Even though we recognize that the problems in the Middle East were still ongoing. Now, if you had done that right around here, you could have bought it back 105. We're obviously in a bullish trend, right? Because of what's going on in the Middle East. So if you're going to sell something bullish to capture profits, you obviously want to be biased towards, buying more aggressively. In other words, you don't want to wait too much for this thing to decline too much, right? So if you didn't sell, you could have sold, let's say, because we reiterated the guidance in the August issue from July. You could have waited, so now it's 111. So what are you going to do now? Well, I would look to be selling this thing pretty damn soon. Okay? I would be looking to sell this thing pretty damn soon. Now, Brent is relatively low relative to historical pricing of the WTI, which means it could go significantly higher, right? That's a possibility. It could bust open to 118, 120 very quickly. So you do want to watch for some quick moves upwards. If this thing starts to lose strength, then you probably want to sell it. But this thing could soar because it's not much higher than the WTI. And you've got these problems going on. The Brent, of course, is the pricing for Europe and Asian oil. You've got the problem in the Middle East and Egypt and so forth. So once again, this is in a bullish trend. You might want to sell it now or soon and look to jump back in aggressively, right? Just kind of have to play it by ear. But one thing's for sure, if you bought this at 105, you should be looking to take profits pretty damn soon. Okay? If you bought it at 109, obviously, you're going to want to wait. You're going to take a chance to wait a little longer, see if you can get more out of it. But once again, this thing could fly. It's possible. Just because Brent has been suppressed relative to WTI recently. Doesn't mean that it's going to, but that's something that, we would look for. Now we have a 2-year chart. You can see here from this chart, it gives us an even more compelling case to remain long and maybe, try and squeak out, 114, maybe even 115 out of this, right? It just depends upon when you entered, what your cost basis is. The lower your cost basis, the more you can be patient, the more you can muster a lower price without pulling the sell trigger. But this is a nice, bullish trend. And now we have the WTI, similar trading guidance for August. It was basically a reiteration from July, and that was to sell soon and look for retracement. Now in that case, we did say, look for mid-90s at least before we got back in. Based upon what's been going on in Egypt, I would say that's from, pretty conservative traders. We're in a bullish run, so if you sell, you want to aggressively get back in a few dollars under what you're selling, right? Or, you may just want to sell and just wait it out. You may not want to, be that aggressive. But you can see you're making higher highs here. You've got 3 higher highs. And it's giving you some trades, but they're not that compelling. So if you're still long, you might still be long. You may have just held on to it. You've only gained a couple of points. I would look to sell this thing pretty soon. And, if you want to get back into it, I think the best thing to do is, unless you're an aggressive trader, a very active trader, you should sell this thing and kind of wait for the dust to settle in Egypt and so forth, and just kind of look for a position back in the mid to low 90s. That's the safest way. That may shut you out of a couple of months of trading, but it's better to do that than be locked in at a cost basis of 104, 105, right? And then watch you all trading between 91 to 95 bucks for a while. So, if you do want to trade this thing aggressively, make sure you put the stop losses in, okay? You're going to have to use stop losses. And I'm going to try and do a video later on to show you all how to use stop losses, when to use them, and how to determine what prices to set. But here, for instance, you probably want to put a stop loss in around 102 if you're going to get in. If you're going to buy this thing, let's say you sold it at 108, and you're looking to rebuy this thing at, let's say, 104, maybe even 103. So what do you put? It triggers at 103. Where do you put the stop loss in? Well, in that case, you'd probably want to put it in at 101.5 or something like that. I typically don't like stop losses. Stop losses are much better for short-term trading, which of course commodities and currencies are shorter-term trading. But if you're not careful with stop losses, you can evaporate your account. The best way, I think, without using stop losses is to be safe, to be careful. And I think right now, we're approaching the top in this cycle of the price of WTI, and it's probably best to be selling pretty soon and just wait till this thing fades. The whole thing clears out and falls down to the mid-90s, mid to low 90s. But again, if you're an aggressive trader, you can play this trading range. Okay, now we have natural gas. Now in the August issue, we advised to go long at 3.2, aggressive traders to go long at 3.2. We've been talking about this 3.2 entry for quite a while, and we said to go for it. And so, as you can see, it's been a very nice trade. It's worked out very well. As you can see, the 3.2 had a nice rally, and it's up to almost 3.5. And so it is approaching a short-term resistance just above 3.5. So you're going to want to look to, if you got into 3.2, you're probably going to want to look to trade this thing to sell it pretty soon. Now, because we've got the situation going on in the Middle East, we've got Brent and WTI soaring. You know, we're going to want to let this thing ride a little bit. We're going to be more biased to let it go a little bit more, but we do want to be looking to sell it. We want to capture these profits. Very nice short-term trade. Very nice gain. But this thing could bust through the resistance. It could, you know, go and even test the close to 3.7, right? It could do that. You may want to start entering stop losses in on this thing, what you might want to do. Just kind of progressively increase your stop losses, right, as it goes higher. And that's generally how I like to use stop losses, is when I've got a winning trade and I think it's going to go higher, but I don't want to lose what I've got. I'll enter stop loss below what I have, and as it goes higher, I'll raise that stop loss more and more and more as it continues to go higher. That's how I like to use stop losses more so. A lot of people like to use them to get out of trades, and so they end up losing money on their stop losses. Well, that adds up. So I like to do it. I think that this way is a more constructive way to use stop losses. But once again, I'll get into that hopefully in another video. Okay, so this is the chart, the CRB from the August issue. And of course, we've been bearish on the CRB index for quite some time now, more than 2 years. We basically nailed the peak of the CRB and discussed the correction that we would see, and we've been nailing that ever since. I showed here the bearish trend and remind you that these things, they sell off and they rally, and they sell off and they rally in a seesaw pattern, bearish seesaw pattern, which means lower highs and lower lows. Okay, so I drew this to show you, to remind you that, you know, this thing's probably going to rebound up to around this range, depending upon when it does, right? Because this slope keeps going down. It's going to lower the rally. But this is, of course, a rough line, especially since it's only over a couple of month period. If you draw this chart over a longer duration, it's going to have a more accurate slope, because you're going to have more data points. So let's have a look now at the chart. And so this is the current chart, and you can see several ways we can draw this line. You can draw it like this if you want. It's a longer term. I drew the other one kind of like this. Doesn't really matter. This is all approximate. You can draw it also to reflect a lower trend as well. But the point is that however we draw this, or we can do kind of an average. This is kind of an average here. It doesn't really matter. The point is, I think you get the point. We are seeing this seesaw pattern. Now, it did break above this line, but that's not a big deal. That's expected. Break above, break below. Because you do have this cycle here, which, you know, you've got a lot of volatility. Huge sell-off, you can have a big rally, big sell-off, big rally. So it's not unexpected. I would say that we probably don't have much more upside to the CRB right now. You know, we're starting to hit this resistance at around 530. It's coming close. We've even got a small resistance here at 525. So probably don't have a whole lot more upside to it. It might be time to sell. Okay, so I'm going to go through a few more commodities and then call it quits. So rice, you'll recall in the August issue, advised aggressive traders to short, to go ahead and put a short position in and look for the 15 before covering. And that was on August 5th, which is right here. So advised to short and target the 15. Well, you can't get any better, folks. Look where Rice sold off to, 15, just a tad below 15, and rallied. Okay, so of course I didn't say go long at 15 because, you know, I don't have a crystal ball. But if you had shorted at 16, around 16 on the 5th or 6th, and looked for that 15 to cover, then obviously if you saw the thing start to go up, you might have gone and taken a long position. Now, for more conservative traders, I said you wanted to wait until this thing rallied to 16 before taking a short. Actually, now that I see this, it looks like this was not the 5th. The 5th was actually just below 16 right here. And so actually what this means is that aggressive and conservative investors should have gotten in on this short, because this did rally to 16 and then it collapsed. So I said to wait, conservative investors to wait for 16 and then take the short, whereas aggressive should just go and take it immediately. So everybody should have gotten in on this short, actually. Now, when I talk about what to look for, in this case, I said to look for the 15 as a target. That's just what I see. It doesn't mean a whole lot. Things can happen, right? So, you know, it may stop at 15.50, you know, or 14, go all the way down to 14. That's what you want to target. That's what you want to look for, right? That's what we're weighing. That's what the evidence points to, but it's not definitive. Now, it just so happens if you look at the historical performance of these targets that we have given, you could actually do pretty damn well by just putting in open orders, limit orders, based upon what we've said. That's not something I would necessarily recommend doing, because this is a monthly publication, right? And things can happen very quickly, especially in the commodities. But as a matter of fact, it has worked out that way. Not every time, but I think a good number of times. I would be curious to see if somebody wants to do that calculation and show the data, show the percentage, you know, of exact triggers or very close. But nevertheless, it's another example of where we completely nailed it. And so from here, if you didn't go long, because once again, I can't lay out every single scenario, every single step, okay? But you should have seen, if you were short, you went and you covered here at 15 or close to 15, you should have gone long once you saw this thing start to rally. So what do you do from here? Well, if you're long, you're probably going to want to look to sell pretty soon. Now, would I short? No, I would not short. I would wait for some more upside, and then I would look for some type of a trigger. If we are getting back up, you know, to this range, my short finger would get trigger happy, say up here. Otherwise, though, I would look to be selling. Now, keep in mind, of course, CRB is in the process of rallying, and the CRB does have some more potential upside, but doesn't have a whole lot. Now, for coffee, we recommended covering the short position from last month, and this is August 5th. August 5th is here. So we closed at 119, and then coffee has rallied to 124. So that's been a pretty good call. Those who remain bearish might have wanted to take another short position at 124 or 123 or even 122. Now, for more conservative traders, we basically said to wait for 100 and then consider taking a long position. But it looks like a short position even from here might be a pretty good short-term trade. That's pretty much all I see right now, because we don't have any extremes. You want to wait for more extremes in price movement before we do anything, and we didn't really get that here after this coffee rebounded 116 to 124, but it is on the way down. It looks like it's going to at least test the 116 again in the near future. Here we have a chart of sugar. The recommendation in August was to take a short position. There hasn't really been much volatility at all. It doesn't look like it's going to do a whole lot. So you may want to cover, just get out, you won't lose any money, and wait for maybe a rally to short, because I don't see anything going on with sugar right now. Okay, so you may remember from the August issue, soybeans actually broke down just below our trading range that we had established previously, 1350 to 1500. It worked out quite well in the past for us, but it broke down last month just below that, 1333, but it wasn't a definitive sign at that point. Now, I felt that there's going to be more downside to soybeans. However, didn't want to keep that short position. Wanted to cover the shorts and wait for a rally. That was the recommendation. Wait for a retracement rally, a bullish rally, before taking another short position. So let's have a look at what's happened since that time. So you can see that soybeans did go a little lower, and then now they have since mounted a huge rally, huge retracement rally. Now this is the time that you're going to want to consider shorting soybeans again. Now there's no triggers, there's no technical triggers, but we're approaching kind of an area of resistance here. And if you made that trade and you got those gains last time, the time before that, you've got some nice profits. You can take a chance. You can get aggressive, and you can look to short this thing. I'm not saying today, but you want to look to short this thing probably pretty soon, over the next few days, next 1, 2, 3 days. If it starts to lose strength, then you want to jump on it and short it. But it's very difficult to short something that's it's going up, right? You want to wait till it looks like it's starting to head down. So maybe give it another day or two, see what goes on. Continues to go up higher, some strength, you want to wait more. Starts to lose some of that strength, weaken, looks like it's going to top out, then you want to start to short it. Okay? Now, if you haven't made profits on this, shorting it, or just normal trading profits, long positions and selling and so forth in the past several months, then you want to be more cautious. You want to wait until this thing starts to crater before you jump on the short. So in the August issue, when we talked about corn, we mentioned that those that remain short, the aggressive traders, as we were recommended to remain short, they really did well. And so we basically recommended in this August issue to start covering soon, unless corn continues to fall. And we said to wait until a rally, those who cover, wait until another rally before we take a short. We do think that corn is going lower. We think it's going to go to 350 to 400 sometime this year, and it could be sooner rather than later. So let's take a look and see what's happening. And so this is the 5th here. We released the report, and it went a little lower, but it certainly wasn't the precipitous type of decline that we had seen in the past. So you might have caught this thing, and once it rallied here, you could have covered. Nevertheless, we basically advised to cover, and it's been the right move because it's now higher than it was in the 5th, right? So it did mount a short-term bullish move or retracement. Now, the retracement that it has mounted thus far is not large enough, in my opinion, to justify a short, unless you're very aggressive. but we do want to wait for some type of a bearish signal, right? I am bearish on corn. I do think it's going considerably lower, but I don't see any reason to short it right now. I'd like to see it go higher, or I'd like to see it start to fall. If it loses strength, starts to fall down, say below 465, then it's probably a good time to go short. Other than that, you want to wait till this thing probably, gosh, I don't know. I'd like to see a nice, healthy recovery, retracement, before I went short again. It's hard to say when, because it all depends upon how much you get of the move in what period of time, right? If you get, over a 2-day period, a move to 520, let's say 520 over a 1 or 2 day period, then you're going to tend to want to get ready to short. But if it takes a week or 2 weeks to go to 540, it's not necessarily a time to short, right? You should know when to look when you see the chart pattern. The bottom line is you want to wait until a retracement, and then you want to wait and see when that retracement starts to lose strength. And this could be the retracement. If it starts to lose a considerable amount of strength, then you're going to want to short it, right? But I think we're going to get a bigger retracement. Now, as you recall, for the August issue, we really didn't have any recommendations for wheat because there wasn't anything compelling. Didn't see anything there, short or long. Now, we are bearish on wheat. We remain bearish. However, that doesn't mean, just because we're bearish, it doesn't mean that you should take a short position, right? Because, wheat could fall only by small amounts, can have rallies and so forth, and we just don't see anything compelling. But we do remain bearish. Maybe we're missing something. So if you see something that we don't see, then by all means take a short position, because we are bearish. And finally, for cotton, you'll recall in the August issue that we didn't really see any compelling trade. We remained bearish on cotton, but we did not see a compelling risk-reward relationship to take or to justify a short trade. So we didn't have any recommendation. But we did say to reevaluate a short position after a rally. So let's see what's happened. It's been about 2 weeks. And wow, look at that. Now that's what you call a rally. Almost immediately after this report was released, August 5th, you can see this thing soared. And, it looks pretty bullish, right? Now, in all fairness, some of you may have taken a short position here or even here, right? Now, if you did have a chance to cover here, and some of you may have taken one here. I mean, this is definitely a nice rally. The only problem is that you also have to keep the full chart in perspective, the longer term chart. And this is one reason why I go over several months of forecasting in each issue. I've discussed this in the past. I don't want to just show you the current month's forecast. I want to show you previous months to give you a flavor, to give you the pulse of the forecasting, and also to give you different charts, because I can't cover all the different chart time spans or durations in each forecasting. So you have other charts to look at, and when I've shown resistance and support levels in previous charts, you need to use those previous charts. So let's take a look at some older charts. Before we do that, let's just go back to the one that we show here in August. And so you can see the support, longer term support is at 70, and we show a resistance here at 90, and then we show another resistance at 100. Now, before we discuss anything about that, I want to go and look at some of the other charts in this August issue to see if we can gain any other information. We just see here that we have some really huge volatility developing. And then in the June chart, you can see the 70, 90 again. In the May, we've got a little bit different 80 to 83. In the June, we've got the 90 to 83. The 90 is the resistance that we want to focus on. You can see that corn rallied pretty quickly up to that 90 level. I mean, it was basically pretty close to two moves and one really big move. And that's a worrisome thing if you are looking to short, right? Remember, we're looking for a retracement as an excuse to short because we don't think that retracement's going to last. But if it breaks through a key resistance, that's a different ball game, right? And I'm bringing this point up because it's something you have to keep in mind. When I say, well, look for a retracement to short, it's implied that that retracement doesn't violate an important resistance. And in this case, it did violate an important resistance. Now, it did stop short of that 90 right here, right? And it did lose some strength, but it immediately popped up. And that's a no-no sign for taking a short position. And so where are we now? Well, we have that other resistance at 100. What would we do? Well, I wouldn't do a whole lot right now. You know, I might look to short this if it approaches 100. But again, I remain bearish. I'm bearish on corn. The CRB has rallied. I don't think the CRB has much more to go for this trading cycle before it sells off. But you know, corn can and has moved very rapidly, and you want to be careful with it. So your best bet is to wait till corn loses strength and then to jump on the short. You don't want to go again. You don't want to short this thing when it's busting up like that, right? Or any security. You don't want to do it. Just because I'm bearish doesn't mean anything. These things can make big swings. So you want to wait until you see a price that's moving down. And you can see here that it's making higher highs and higher lows. Very much higher highs and very much higher lows. So that's a very bullish sign. Would I go long? No, I would not. But I sure as hell wouldn't go short either. Wait for something compelling to take a short position. Okay? And the reason why I wouldn't go long is because overall I have a sentiment that is bearish on corn. Over the short term, you know, it's probably going to go a little higher. If you're not able to catch though, when that trade stops, you could get blasted when this thing falls apart. Okay, that's pretty much it. I hope that you all enjoyed this. You benefited from it. It's about a 2-week period since the commodities was released, so this is kind of a mid report, and that's about it.